Hi folks, welcome back to ICT with a very brief discussion on how to find intraday trending days. Now, what is an intraday trending day? When you're looking for an obvious buy condition for day trades or scalps, or sell short days where it's just most likely to work in conjunction with the higher time frame bias. Now you can see since the month of March of 2020, the dollar has had a real difficult time trying to go higher. So the obvious momentum has been on the downside. Now, I'm going to ask you to grant me a little liberty here, because I know a lot of people like to give me flack about how I'm pointing at hindsight when I've given examples on here where you can see me trading before the stuff actually unfolds. So just give me a little bit of flexibility here, and I'm going to teach you something that we can go into the charts and start looking for it, okay? So when you have a market that is predisposed to go down, in this example here, we're working with the dollar. Everything that I describe here would be the opposite for like euro or cable, which is British pound versus US dollar. And we're going to look at a few things, and I'm not going to do a whole lot of it in the chart. It's basically you listening and taking notes. Now, I'm going to point at some things in the chart, but most of this is going to be just me giving you the lecture points, okay, or the salient points that you should come away from this teaching. When the market's predisposed to go lower, we are going to work within the framework of Monday, Tuesday, Wednesday are going to be your best ideal entry days. Now, if we were looking at the dollar index as we have here, and it's been bearish, each week we go in looking for the continuation of this underlying premise. Premise being that the dollar is weak, it's going to go lower. So therefore, if the algorithm is going to reprice at a lower price for the dollar, you're going to be best suited looking for short sells or going short on Monday, Tuesday, or Wednesday. Now, it does not mean, and it's not limited to just those 3 days, it can still have a sell-off day on Thursday and Friday. Every single day of the week could be down days. The topic of this lecture is how to find trending days where everything is perfect. It's just an ideal scenario. If you're familiar with my lesson on power of three, okay, power of three is the open, high, low, close phenomenon when the market is bearish, where we can go short at the opening price of the daily range or above it, and then ride the daily range down to what would be classically referred to as the closing price. Well, since the foreign exchange and Forex market doesn't technically really close until Friday, what am I referring to? And I'll give you a little bit of talking points about that too, so you can go into your charts and dress them up, and you'll see right away what I'm talking about. So we're looking at a market that is predisposed to go lower, as I said, and that means in this example, we're going to be looking for Monday, Tuesday, Wednesday sell days. Now, if we look at what has just transpired last week, we had a run below this low here. Okay. Using this mindset, going into the week with the expectation that Monday, Tuesday, and or Wednesday could be really classic down days. Now, what is a classic down day? Let's go into the hourly chart, and I'll give you some information about what classifies a classic down day and what characteristics are available when we're looking for it. Okay, so we are in the hourly chart for dollar index. And I'm going to add the daily separators, and this line here is that old low I referenced on the daily chart before I drop down into the hourly chart. So the idea is that we're looking at a bearish market environment, and whether you want to call it momentum, whether you want to call it trend, whatever it is that you are classifying the dollar as for your model, is it going to be bullish or bearish? We're going to assume that whatever that was that you arrived at, lower lows, lower highs, all that business. You know, you might use moving averages if you're an indicator type of person. I don't really use indicators like that, but if it helps and it works for you, then by all means, I guess, continue to use it. But if you look at how Monday's trading started, okay, we opened up here, traded higher, made a high, which happens to be the high of the week. So as I indicated at the beginning of the video, and I teach this in other lessons, how to find explosive price action moves is one of my classic teachings where I teach the weekly power of three, which is the phenomenon like where we open, create the high of the week, and break down. On Tuesday, we trade it again higher, and then work towards the low end of the range later in the day. And then Wednesday, we get another rally initially during a London session, and the market trades lower. And then on Thursday, we get the same phenomenon. We open, rally up, create the high of the day, and trades low, making the low of the day, and then consolidates into that. And then finally, Friday makes the low of the week, and it goes into consolidation as the trading week closes. Now, that is obvious, and for most of you that are very cynical, you'll see that and say, well, it's obvious. What am I supposed to take away from this that I don't already know? If you're bearish on a higher time frame, weekly and daily, both of those time frames agree, or your analysis lends well to it continually moving lower, then you're focusing on Monday, Tuesday, and Wednesday to see these types of phenomena where it creates a high and then the market repels away from that. Does it stay at the highs long? No. It leaves it quickly here, tries to run back up, rebalances in here, and then breaks down aggressively. Wednesday, again, same scenario. We run up and then break down hard. Thursday, I want you to look at this pattern right there. Okay, see that? Now I didn't send this chart on to my community tab, but I showed you a 5-minute chart of this particular day. So in your notes, I want you to write down that when you are bearish on higher time frame charts, weekly and daily, if both of those agree, and there's many lessons in my YouTube channel that will help you derive what that direction should be or how to find that direction using the way I do it. And if they agree and they're saying both of them are bearish, every single trading week, you go into your analysis with the expectation of a sell scenario forming on a Monday, a Tuesday, and a Wednesday. Now, it can continue into Thursday, but if it's bearish, there's a high probability that the weekly range will create the opposite end. In other words, if we're expecting bearishness and a big down week, Thursday tends to make the low of the week about 65 to 70% of the time during the New York Open, okay, or the New York session. There are times when it will continue on into Friday. In this case, it went down just a little bit more, met a target that I gave to my community, and then repelled. That's not the scope of this lesson. Now, before you get upset and you think, oh, you're holding things back, why'd you even bother coming here? I want you to think about the likelihood of this being where you targeted for the dollar, and say you were able to capture a move from here or here or here. Would you be upset if you got out there when it only went down this far the following day? Now I'll ask you another question with a similar vein. What happens if you took your profits with the analysis saying here is the time when you thought that the weekly range would end? It wouldn't go any lower. But then it went down another 80 pips. Would you be upset? If you said yes, you need to reevaluate why you would be upset about that. Because if you were able to get out there or in close proximity to that low, from this entry point here, here, or here, that's an enormous amount of range. Like that's the lion's portion of the weekly range. So no one, if they're able to capture that, should be upset. Because if you feel that it's something to get upset about, if you hold only to here and it drops an additional 80 pips, you're wrestling with something that is not realistic, because you're not going to get every piece of every move. That's not going to happen. I don't teach that. I don't promise that. And no mentor or teacher should. And if they do, that's a clear indication you need to run away from them, because they're promising you the moon and they can't deliver it. What can we do with this information, though? Let's assume for a moment that you believe what I'm suggesting. You go into your charts and look for it. Now, right away, some of you are going to say, okay, Michael said every bearish week is going to have a sell on Monday, Tuesday, and Wednesday. And then Thursday could happen to have another down day. And you're going to look for every instance that it does not fit that criteria. And the things that you're going to be not paying attention to is there are times when this market should be expanding, creating these big weekly ranges. There isn't always going to be this big weekly range expansion on the downside, or conversely, big range expansions on the upside. There are things that you have to learn from a market structure standpoint, and I give a lot of those types of lessons in this YouTube channel for free. But when we break a low, like this line up here indicated on the daily chart, when we broke through that, you always anticipate some measure of expansion. Now, you're classically taught to look for a break and retest and then go short. Well, you can see they went below it here, then pumped it up above it. That is a little unsettling for people that like to use support and resistance, because why didn't it stop right there? The market trades one more time below it and goes right back above again. But notice it doesn't stop right at that old low. Again, this level here, go back, rewind the video, you'll see this low. If you look at your own charts on TradingView for dollar, you'll see that this level here, 91.74 and 6 pipettes, is the level that's that old low on the daily chart. So it goes below it and then sweeps back above it. It's not just going above it because it's random. It's going above it to rebalance this little area right in here. Okay, you see that? So after it rebalances there, it breaks down aggressively. But now this red line is not the low that we're watching. This low is the Monday low. So what we're doing is we're watching, does it have the ability to break the previous day's low? Does it break it in a subtle manner? No, it expands aggressively through it. So it's destroying this low here and confirming the run below here. So it's done it on Monday, creating a high. On Tuesday, it shows aggressive movement lower. Now on Wednesday, when new traders or neophytes watch real-time intraday price action during London, they see these big pops up. And they think, okay, well, they'll look at these lows here, and I'll put momentum indicators like CCI, stochastic, RSI, you know what I'm talking about, the overbought, oversold indicators. And they'll be flagging bullish divergence. And they'll be thinking, okay, it's created a low. And they may think that maybe it could trade back up to that level here because that's an old higher time frame low. So that could be a resistance level. And when they start to chase price like that, it will be very frustrating for them when it starts to break down again. When it starts to break down, what low would they be attacking? The low that was formed in early trading on the 2nd. Does it trade through that subtly? No, it aggressively punches through it with energy, then comes back up, rebalances, and then sells off again going into the close. Now on Thursday, the same type of phenomenon we're expecting. We're waiting for it to open, create a high of the day in London session, and then trading aggressively lower, but then forming a low during the New York session. That low that forms on the New York session tends to be, with a great deal of statistical evidence behind it, and I'll leave that to you. There are strong statistics that support Thursday being the low of the week in the New York session when we're having a large expansion weekly range. Okay. If you looked at my community tab that day, okay, I said, pay the trader. That's the moniker I use all the time when I say, prompting my students, okay, in your notes, you should be saying this is where the lines portion of the move is then put in. So therefore, I would be classically moving to the sidelines and taking profit. I did that right before all of this run here. So it was done real time on my community tab. My target for the week was 90.47 and 7 pipettes. And the low of the week come in 1 pipette below. You can see that low here at 90.47 and 6 pipettes. So it went 1 pipette lower than I was expecting. And then it created the low of the week. Now Friday, like Mondays, if you can grow in allowing yourself to say, okay, I can take trades on Monday. I can take trades on Friday. I'm not completely opposed to it, but there are better trading opportunities on Tuesday, Wednesday, and sometimes on Thursday. Thursdays tend to be really good reversal days. And Tuesday and Wednesday tend to be really good trend entry days. Now, think about what I just gave you. When a market's bearish, You want to be looking for ideal scenarios to sell short Monday, Tuesday, and Wednesday. I'm willing to give up Monday's trading, because what Monday's trading does, it gives me a little bit more insight as to what the weekly range may do, because I have weekly profiles that I classify certain scenarios the algorithm will likely unfold throughout the week. And what do I mean by that? They're like little schematics that give us the rough idea on how the daily ranges will print. Now, that probably sounds crazy, but they're just general rules of thumb. They don't always exactly pan out. They are good rules of thumb. They help guide me and my students, but it takes a lot of experience to learn them. And sometimes I get it wrong, and that's nothing wrong with that. But if we're overwhelmingly bearish, as we have been for dollar, it is a huge advantage, especially if you're a new trader, to anticipate Mondays, Tuesdays, and Wednesdays to be amazing selling days or going short. During the London session, again, that's where I teach it, even in this YouTube channel for free. That's when the intra-week, now what does that mean, intra-week? This is an intra-week high, this is an intra-week high, and this is an intra-week high during the Monday and Friday's trading range. Whatever that range is that forms the weekly range, every short-term high here in the London session are respective intra-week highs. I'm looking for the market to move away from these intra-week highs or individual intraday highs and attack previous day's lows. If I see that, what I'm getting in line with is the institutional order flow. So now I have a preconceived idea of bearishness on the weekly and the daily for dollar. If we drop into these lower time frame charts, we start looking for these things to occur to support our narrative. The narrative is that the dollar should go lower up to New York on Thursday. So that would be right in here. So here's 9 o'clock in the morning on Thursday. And I asked you to look at this range in here. So is it hard to see this pattern in hindsight? Well, that will depend on how much time you want to put into studying it. I'm giving you these details to go into your chart and start looking at it. Studying every individual weekly range and individual daily ranges, the Monday, the Tuesday, and the Wednesday, and how it trades into Thursday on New York Open. That is such a huge advantage. And if I would have known these things when I first started in 1992, I would have done very, very well and not probably had as much pain in my development than I had to endure. But I want to go into this little area here, and we'll drop down into that 5-minute chart, and we'll wrap this video up. Okay, so we're zoomed in on a 5-minute chart of the dollar index on the 3rd of December. So this is last week's trading, and this is what I call a classic trending day, or a classic bearish ICT Power 3 day, where we open, make the high of the day first, expansion, makes the low of the day, and then consolidates into the close. When you're looking at Forex, okay, and I know a lot of my audience are spread out across the globe like everybody else on YouTube. Everyone is not in the same geographic location. The way we compensate for that is on the time window thing down here. You want to set that to New York. Okay, so New York time frame. If you click that, everything I'm showing you here will line up perfectly. You just have to figure out what that means at your local time. Okay, so to save myself a lot of confusion and a lot of work, please don't email me and ask me what the conversion is. If you set your TradingView charts to New York time, everything that I teach on this YouTube channel will make sense. But if you try to set it to your local time, it's going to be very confusing, and you're going to see that this stuff isn't lining up like you would imagine it doing, because it's not set to your local time. Okay, it's not set to time in France. Okay, it's not following that clock. It's not following the clock in Hawaii. Okay, you set it to New York time. Everything is relative to New York time. You can be mad about that, you can be upset about it, or you can just say, all right, Michael's saying that, so I'm going to just do that. And that's all I'm asking you to do. Just do it, and everything else will fall in line. This vertical line here indicates midnight, New York time. If you add another vertical line at noon, right there. Okay, you have the two dividing time windows that I use to teach my students. All of the stuff that happens after this, not important to me. Everything prior to this, not important to me. For the daily range, you're going to look at these two specific times. It's a 12-hour window. Opening, if we're bearish, we don't care about the rundown. We want to see it run up above the opening price. This is my classic Power 3 idea. The high forms at 4:40 a.m. on Thursday. The market breaks down, comes back up, rebalances in here, trades into a bearish order block right here, right there. Why not this one here, Michael? Look at that. I mean, widen this up. I know some of you are saying, why do you pick that one and not this one? I told you, I'm almost like I'm clairvoyant. This candle has a larger body. Even though this one's higher, this is something else. But I'm using the order block here. This is your order block, not this one, because we don't teach supply and demand. And there's other things in this chart, and no, it's not just the fair value gap either. So I know you guys have been introduced to that. This is your bearish order block. So it trades up into that, bumps the body of that here, and then breaks down. We trade back up a little bit, subtlety, and then break down again. Market trades back up again here. What is this? See that? What is this? That's the optimal trade entry. What is this? Optimal trade entry. Here, and then you have it here. Okay. If we have an optimal trade entry and it starts to sell off, what are we expecting it to attack? That low. If it breaks this low, how far can it go? Well, you have two factors here. You have the element of time and price. Not price and time, time and price. So if we have, in terms of time, all right, so we have it set to 10 o'clock to 11, okay? That's your sweet spot. That is the sweet spot of London close. What did I mention earlier in this video? That we can generally anticipate the low forming during the New York session on Thursday. But what closes that window and has an overlap of an important turning point intraday? London close. So we're going to use the 10 o'clock in the morning to 11 o'clock in the morning profit taking period where intraday traders, they usually square their positions around that time. Now it can go as long as noonday, which is here. But this is the general area where I like to take profits. And if you look at some of my old videos, this is something that I taught pretty religiously. So we have the London session high, optimal trade entry. Then we have the New York session. This candle here, 7 o'clock in the morning, right there. Okay, so it's setting up the optimal trade entry that would sell off during New York session. And we want to see it attack this low. If it does, what can we anticipate in terms of a target? If we're in a trending model and the market is clearly indicated that it wants to go lower, has shown it on the weekly, has shown it on the daily, and we've seen Monday and Tuesday and Wednesday indicate that it is absolutely working to a large expansion on the downside for the weekly range. So that means Thursday could start to see what? A big range day. Everyone else is thinking it's oversold. It's oversold. It's oversold. So when we attack this low, how far can it go? Well, let's take a look at that. I like to use a fib for targets. One of the things that I mentioned a few times in my discussions on this channel is my weakest point has always been my exits. And not because I can't find profitable exit points. It's because I can't find contentment. I'm always looking at it after the fact and saying, I wish I would have did this. I wish I would have done that. So no one's ever right in this industry. Okay. You're never, even if you're profitable, you're never right. Gentlemen, if you're married, your wife is definitely going to tell you that you aren't right. Okay. Because you lost money. But you as the man, even when you are profitable, you aren't going to feel right either, because it may go a little bit further. You'll wish you had more on the trade. It's just, you're never going to be content. So in my honesty, the flesh of me, okay, I wrestle with this idea of perfection on my exits, where my entries can be scary accurate. My exits, I have to do it as a grouping. And so I have adopted this idea of taking logical partials or taking a specific price level and just completely getting out of it. If I'm really conflicted about how far I think it's going to go, I just pick a really good middle ground exit point and I just take all of it off there. And I just tell myself it is what it is. If I miss out on another 100 pips, who cares? Usually I'm taking down 50 to 75 pips, and who cares what, somebody else can say they made. I don't care. If you wrestle with that all the time, you're just going to be miserable, and you won't enjoy this industry. You won't enjoy the career that you're trying to frame for yourself, or a hobby. It depends on how you want to look at it. But initially, you have to look at it like it's a college degree that means something at the end, because you're not going to do this with a couple weeks of study or a couple months and know how to do it, because you need to figure out a lot of things about yourself. But this framework I'm going to give you here will give you one of the ways I like to look for specific price levels, but coupling it with time. So again, what's the first element? Time. So we're aiming for this particular time window of the day between 10 o'clock and 11 o'clock in the morning. Now, there's going to be times when it will make the low of the day just before 10 o'clock in the morning, and you'll be like, oh, it was early. And sometimes it'll go into 11:30, quarter to 12. And sometimes it might be 12:15. These are general rules of thumb. There's always going to be some slight little variance in here and there, but it's going to serve you better than anything else out there in the retail logic. So we're aiming and holding, willing to hold until we get into this time window. Okay, we enter that time window about right there in this candle. It starts in that candle at 10 o'clock. So that candle could have been the low of the day. Well, how do you know, Michael? Because now you're just talking about, it could have been this one, it could have been this one, in this one, it could have been that one, or, what about that one? That could have been it, right? Why this one? Now, to get the element of price, because we have the time window down here, I moved up to the hourly chart, and this is our Wednesday price swing high, and then it starts to break down. Wednesday's high and the sell-off prior to these lows being taken out, we can know a high degree of probability of a particular price level being traded to. The way you do that is you want to take the high to the low here. Okay, that high to that low. Why? Because this is an impulse leg, and this is a fulcrum point. When the breaks below that, this range here projected down is here. That's one standard deviation of this low to high. Just imagine this being a hinge, and this swings down to here. But markets aren't always perfectly symmetrical like that. So this is the reason why I taught you how to use halves. Okay, so every standard deviation has a half. So this is one full standard deviation and 1.5. What's the 1.5? 90.521. 90.521. Let's add that to our chart. Okay, and we're going to drop back down into that 5-minute chart. Okay, so here's the optimal trade entry on that particular day for London. Then we have it here for New York. The market breaks this low. How far can it go down? We have this price level here and the overlap of time. Look at the bodies in here. Yes, you have little tails that went a little bit lower, but look at the bodies respecting this level. That's not random. The market seeks these levels and couples it with time. So this area in terms of time and this particular price level with the fib, that's a target. This is the very reason why I said on my community tab, see that low on Dixie? Wave. That's the low of the day on Thursday. So here's how that overlap worked out with time and price. Time is the element that you hold for. You submit to that because you don't know how long it's going to take outside of specific time windows. You have London close, you have New York open, London open, and Asia. New York close is a little quirky, so I don't try to teach too much of that even in my mentorship, because you have to have a whole lot of things understood before that is even useful to you. And usually that's like the 2 o'clock to 4 o'clock in the afternoon window, and usually 2 o'clock on the biggest extreme days. Usually 2 o'clock hour usually completes the daily range. For this example, what I've outlined here is how the element of price with time initially is a more important factor than just simply a price level. Back to the hourly chart, we can look at how this one standard deviation here, and that is a 90, 71, and 6, and the price level is 90, 71, and 7. So just to keep things honest, there we go. And now we're going to drop back down into that 5-minute chart. Here's that first objective with one standard deviation using the previous day's range and projecting it down. Notice that at that price level, okay, it did not trade at that level at the same time that 10 o'clock to 11 o'clock in the morning. And I'll show you what that looks like here. Okay, so at 10 o'clock in the morning, we were already below this target here. So that's the reason why I teach time and price, because the algorithm is looking at time first and foremost, then price. So if this would have been touched or traded to at 10 o'clock in the morning, which it traded to it here initially. So at 7:50, is that an element of time that I've outlined here for London close, but still during New York? No. It trades through it here. It's trading around it here. It's 9:35, 9:40 New York time, and then it leaves it. So it starts to move away. So if it takes out this low here, what should you be aiming for? This price level and holding up to 10 o'clock in the morning to 11 o'clock to see that target be met. And the algorithm delivers that price perfectly. Now you get a little bit of tails in here, but look at the bodies. Look at the close on this price here. 90.519. 519. That's 3 pipettes away from a projected low of the day that you could calculate back here. Think about that. That's crazy. And you couple that with entry patterns and you start to see how I can do the things that I teach and illustrate on this channel. It's not always just hindsight, folks, but you have to learn things conceptually through an element of hindsight. This is how you see things conceptually, and it gives you just enough evidence to go into your charts to collect intel for your own. Then you can start seeing these things, patterns and completions of time and price. They're algorithmic and they repeat a lot, but you have to have certain things in agreement to get them. Now, I could have just simply said this is in hindsight and there it is, but I used it in front of all of you during this particular day. The very next day, it trades to our objective that our community has been looking for the dollar, which was 90.47 and 7 pipettes. And it went 1 pipette below that. Not even a half a pip, not a quarter of a pip, 1 pipette, 1/10 of a pip. That's the error I had there. So it went 1/10 of a pip beyond what I was calling for, and then made the low of the week. So if you're looking for big trending days, you want to be looking at higher time frame charts and then blending elements of Monday, Tuesday, Wednesday. And is it showing a willingness to create highs in London or New York, but preferably in London? And are we seeing expansion on the daily ranges? Is it taking out previous day's lows? And is it doing it convincingly? If it's doing that, then you can start doing time elements like I'm showing you here on Wednesdays and Thursday. But just know that Thursday could create the low of the week, And there it is. Now, what's the benefit of this? Because sometimes my weekly objectives may not get hit, and Thursday creates the low, and Friday could have not went a little bit lower to trade to our 90, 47, and 7. This could have been it, and that would have been fine because I outlined it in front of you on the community tab on my YouTube channel. But the details behind it is what I'm showing you right here, just for that Thursday, not the delivery of Friday's low of the week. That's something entirely different. And then some of you are like, "Oh, see here it is. You're holding back." No, you're not entitled to it here. But my students seen this, and you all seen me outline the low on Thursday. I'm giving you the dynamics behind it and teaching what would otherwise be something that only a mentorship level student would look at and see and teaching by me. There is this repeating signature that happens a lot. Everything I'm showing you here, if you reverse it when you're bullish, everything would be just the opposite here. You'll be looking for projected highs. You'll be looking for time and price to meet. And everything should be showing lows of the day forming on London on Monday, Tuesday, and Wednesday. And previous days' highs are being taken out. So it's showing you by sheer force of breaking through previous days' highs. And the time element is an agreement. London is creating these lows of the day when it's bullish, just like it was creating the highs of the days that we were showing for the last week. So when you blend those things together, I don't trade dollar, but this gives us insight on how to trade euro and cable. So if we compare, I'll just add euro real quick just for the sake of completeness. So here is euro just doing a mirror opposite. It creates the high of the day here when the dollar makes its projected low of the day. So if you're trading and using the things I teach, this in your demo account for dollar analysis, this would be your buys in euro dollar, and everything's a complete mirror image. So we start our analysis with the dollar because it's like a barometer. It tells us, should we be bearish, should we be bullish? If the dollar index is consolidating, then that means you have to look at crosses. That means currency pairs like euro pound. And then if that's bullish, that'll give you greater insights about which pair you should be trading, euro dollar or pound dollar. While the dollar index itself will stay in consolidation, crosses will be allowed to move. And that's usually when they trend. But when the dollar index is trending or it's in swing, euro pound tends to be in consolidation. So hopefully you found something in this video that was insightful. I know it's a little bit of a thinking cap required to go into your own charts and study it, but this is what it's like to be under my wing. You get certain things given to you, and then you're encouraged to go out into your own charts and study it. You're going to be met with weeks where Monday and Tuesday and Wednesday, when you think it's bearish, isn't going to give you sell days. And I want you to study when that occurs, and study it in reference to the weekly chart and the daily chart. Did we just trade down to an old low and run through that old low, and now it's starting to retrace? Because if it's doing that and you anticipate it being a bearish week, it's likely not to form a Monday, Tuesday, or Wednesday sell-off, because it's probably retracing deeper to create a more deeper retracement, so that way it can go overbought, if you will, on a near term. And then the following week, you can anticipate a Monday, Tuesday, and Wednesday scenario where it creates selling days that are just perfect. So it's not a matter of everything is going to be exactly like this every single time. You have to blend in some things. I just gave you a huge hint just 30 seconds ago. If that just went over your head and you didn't write that down in your journal to start looking for that, you've missed it, because that is gold. So until I talk to you next time, please be safe and good luck in good trading.